Nasdaq 100 futures are currently sliding over 1% in the pre-market session, while Dow futures are actually sitting in the green, up about 0.2%. It is Friday, June 26, 2026.
Yeah, the bell hasn't rung yet, but the overnight session just handed us a massive divergence.
Right. And in today's deep dive, we are unpacking the institutional market intelligence to figure out if this is just a routine valuation reset or if the cracks in the massive AI supercycle are actually starting to split open.
I mean, looking at the pre-market volume, it's definitely feeling like the latter.
Completely. It's like watching a duck on a pond,
Yeah.
you know? The broader economy looks calm and green on the surface, but underneath, the tech sector is just paddling frantically and bleeding red.
Yeah, that's a good way to put it. Or think of a massive cargo ship. Up on the top deck, people are clinking champagne glasses because the Dow is fine. But down in the engine room, where tech lives, they're taking on water fast.
And to figure out why that engine room is flooding, we have to look at the catalyst, which really comes down to the bill for the AI boom finally coming due.
Exactly. We've been living in this absolute euphoria of hypothetical AI value. Trillions of dollars. But Wall Street is aggressively waking up this morning to ask who is actually going to pay the physical cost of building it all.
Let's get right into the specific movers then. I saw the alerts flashing yesterday on Apple, but run me through the exact pre-market numbers.
Right, so Apple took a very sharp 6.1% plunge yesterday, dropping their stock down to $275.15.
Which is a massive move for them, and it wasn't a software bug or a recall that sparked it.
No, it was a stark announcement that they're initiating aggressive price hikes across their Mac and iPad product lines. They aren't padding profits here. They're doing it as an emergency measure to offset the skyrocketing costs of the memory and storage chips they need to run AI locally on the devices.
And right on top of that, we had the UBS report drop, right?
Yeah, making matters worse, UBS reported that May iPhone shipments into China, obviously a critical growth market, dropped a staggering 19% year over year.
Okay, let's unpack this, because for the last 2 years, we've talked about AI as this infinite resource floating in the cloud. But you're saying the physical hardware costs are getting so heavy that even Apple is sweating.
What's fascinating here is the sheer mechanics of the margin squeeze. Every time you ask an AI to generate an image, it requires intense computing power, which means specialized silicon. Because everyone is building AI, the cost of those physical wafers has exploded.
Right.
So when Apple's cost to build an iPad goes up, their profit margin shrinks. To protect that, they have to raise the price for the consumer. It's an AI tax that everyday people are suddenly being asked to pay.
But is the consumer actually going to pay it? I mean, it feels a bit like a high-end restaurant where the chef starts shaving rare white truffles over every single dish.
Right, and hikes the prices 30%.
The ultra-wealthy regulars might not care, but at what point does the average diner look at an $1,199 price tag for an iPad Pro in a slowing global economy, mind you, and just decide to eat somewhere else?
Well, that 19% drop in Chinese shipments is the consumer explicitly refusing to pay that inflated bill. Apple is testing the absolute limits of its pricing power. If buyers balk, Apple has to absorb those chip costs, which crushes profitability.
And it's not just hardware.
No, not at all. Overnight reports suggest OpenAI is actively considering delaying its highly anticipated IPO until 2027.
Just to protect that steep $1 trillion valuation target.
Exactly. The market is suddenly demanding to see actual, sustainable consumer profits, not just endless infrastructure spending.
Wait, but if Apple is paying an absolute fortune for these specialized memory chips, then logically the semiconductor stocks should be soaring this morning. They're the ones catching all that cash.
It seems totally counterintuitive, but the math is telling a very different story today. Look at Micron Technology. Yesterday, they delivered an absolute blowout Q3 report.
I saw that. They forecasted, what, $50 billion in Q4 revenue?
$50 billion, yeah. And initially, the stock skyrocketed 15% on the news. But this morning, it's shedding 4.8% in the pre-market, slipping all the way back down toward its historical support levels between $11.50 and $12.00.
That makes zero sense to a retail trader. A company announces $50 billion in revenue, and traders punish them for it. It's not exactly a gap-and-go setup.
Not at all.
It's like funding a blockbuster movie, you know?
Yeah.
The trailers have played for a year, the hype is massive, it breaks every box office record. But to the early investors, that premiere isn't a signal to buy more tickets, it's the exit door.
If we connect this to the bigger picture, you've perfectly described the sell the news phenomenon. The fundamental business for these chip makers is incredibly strong, But the stock prices had already priced in absolute perfection.
So a flawless earnings report is just a liquidity event.
Exactly. It's a chance for massive institutional desks to cash out their gains while the retail crowd is cheering.
Yeah.
And because they manage global portfolios, the profit-taking causes a ripple effect.
Which we saw in the Asian session.
Yeah. Overnight, South Korean memory giants Samsung and SK Hynix plunged, and SoftBank plummeted over 12% in Tokyo.
Brutal. And it isn't just profit-taking dragging semis down today. Semiconductor is taking a huge hit this morning on an acquisition. What's the ticker doing?
On is tumbling over 9% pre-market, down to $108.88. They just announced a $7 billion all-stock buyout of Synaptics.
An all-stock deal, right as they pivot into edge AI.
Yeah, they want to put AI processing directly on consumer devices. But Wall Street immediately slapped them with a downgrade to hold from TD Cowen.
Because of the massive equity dilution. I mean, issuing billions in new shares to fund a pivot into consumer hardware right when we just established consumer demand is cracking. For Apple investors, are going to hate that.
They absolutely hate it. Your individual slice of the company just got noticeably smaller.
Yeah.
Right at the peak of market anxiety.
Here's where it gets really interesting, though. If institutional capital is aggressively fleeing tech and dumping semiconductors globally, that cash isn't just vaporizing.
No, it has to land somewhere.
Right. And usually when tech bleeds this badly, we assume there's a panic about the macro data rates or inflation. But yesterday's inflation print wasn't actually that scary.
No, the macro data is providing a fascinating contrast today. We got the May PCE inflation data yesterday. Headline PCE hit 4.1%, which is a three-year high. And core PCE is sitting at 3.4%.
Which is still almost double the Fed's 2% target. So inflation is sticky.
It's sticky, but the bond market didn't panic because there was no hot surprise. It was exactly what Wall Street expected. So the yield on the 10-year Treasury actually eased down to 4.38%, and the dollar index dipped slightly to 101.46.
Which is the ultimate paradox. I mean, falling yields are supposed to act like rocket fuel for the Nasdaq. Tech companies rely on cheap borrowing. Why is the tech sector completely ignoring this macro tailwind?
This raises an important question about market rotation. The macro environment is theoretically giving tech a free pass today, but that micro plumbing, the AI infrastructure cost fatigue, is overriding it entirely.
So they're choosing reliability over romance.
Exactly. They're rotating cash out of hyper-growth tech and pouring it straight into industrials. Look at the XLI ETF.
Oh, the irony is amazing. We are in the middle of a futuristic AI boom, and the smartest money on Wall Street is hiding out in tractors. Deere and Caterpillar hit absolute record highs yesterday.
It speaks to the pragmatic nature of institutional capital. A tractor manufacturer has predictable costs, tangible assets, and reliable cash flow. Right now, Wall Street is deciding a physical bulldozer is priced much more attractively than a speculative neural network.
Okay, so money is moving from tech to tractors, but to really grasp why the pre-market is behaving so violently this specific Friday, we have to talk about the market plumbing. What is the structural trap today?
Well, today is Russell Reconstitution Day. It's one of the most volatile trading days of the entire year. The Russell indexes are entirely rebalanced, meaning hundreds of billions of dollars are legally mandated to move to match the new index rules.
And this all culminates at the end of the day, right? At the 4:00 p.m. Eastern Nasdaq closing cross.
Yeah, the market has to process a gargantuan, chaotic flood of buy and sell orders simultaneously at the bell. Institutional desks know this forced volume is coming. So during the thin pre-market session this morning, they aggressively short tech to push prices down.
Trying to flesh out the weak retail hands. And our research notes they are specifically testing the lines in the sand today, 7,350 for the S&P 500 and 29,200 for the Nasdaq 100.
Those are the critical support levels. If institutions can push the S&P below 7,350, that psychological floor breaks, algorithms start auto-selling, and tech faces its fifth straight day of declines.
I have to push back on this, just thinking like an active trader listening right now. If I know 7,350 is the magic floor, and I know institutions are artificially suppressing the price before the 4:00 p.m. rebalance, shouldn't I buy the dip?
Play the hero.
Yeah, try to front-run the index funds that are forced to buy at the close.
It is incredibly tempting, but the playbook explicitly dictates staying completely sidelined after 3:30 p.m. today. Any directional breakout you try to play is going to be instantly snuffed out by the massive crosscurrents.
It's like playing high-stakes poker against the casino, but the dealers are actively changing the rules mid-hand. Suddenly, threes are wild, the river is dealt in the dark, and your pocket aces are dead. Preserving capital is the only winning move when the plumbing is this distorted.
That's the perfect analogy. You aren't trading against human psychology this afternoon. You're trading against mandatory order flows. If you jump in, you are just providing liquidity for the giants to feast on. Let the algorithms fight it out.
Let's talk about the longer-term trapdoor, though. Because if retail is getting chopped up in the Russell rebalance today, our sources point to a much bigger invisible pain trade they are completely blind to.
This is probably the most critical macro insight we have today. Retail investors are historically deeply leveraged in the tech sector right now. Out of the $739 billion in annualized inflows from everyday people, $154 billion went directly into chasing tech, AI, and chips.
They are overwhelmingly betting the gap, and go continues forever. But the institutions are looking at the calendar. Today isn't just the Russell rebalance, it is June 26th, the end of Q2.
All right, and massive pension funds have to programmatically rebalance their books at the end of every quarter. Most operate on strict 60-40 asset allocation rules, 60% stocks, 40% bonds.
Walk us through the math on how that triggers tech selling.
Because inflation has been sticky, the actual value of the bonds in their portfolio has dropped. The bond allocation is shrinking. Meanwhile, tech stocks have been surging, so the stock allocation has swelled maybe to 70%.
Oh, wow. So to get back to 60-40, they are legally mandated to chop off that top 10% of stocks.
Exactly. They are forced to sell their winning tech shares to buy depreciated bonds. And it's uniquely dangerous right now because these are high beta assets.
Meaning they swing wildly compared to the broader market.
Yeah. If the 10-year yield spikes back toward 4.50%, algorithmic risk models will automatically dump these highest beta tech stocks first.
So synthesizing all this for you listening, when you combine forced quarter-end pension selling with algorithmic yield panic, it's like a massive luxury ocean liner. Retail traders are up on deck fighting over lounge chairs, totally oblivious that the ship's engines are failing.
While the institutional giants down below are quietly reserving all the lifeboats.
Exactly. Institutions see that a guaranteed return in short-duration T-bills is vastly superior to paying 20 times forward earnings for speculative AI growth. By the time retail realizes the ship has stopped, the lifeboats are gone.
The pain trade is precisely that realization. The crowd panics, tries to exit through a narrow door all at once, and finds the smart money already evacuated. Programmatic selling will instantly overpower any retail attempt to buy the dip.
All right, let's briefly recap the journey here. We decoded the bizarre pre-market divergence. This is not a random Friday dip. You are witnessing a violent collision of physical AI infrastructure costs, squeezing margins, end-of-quarter pension rebalancing, and the chaotic plumbing of the Russell Index reconstitution.
It's a complex ecosystem. But understanding how a margin squeeze triggers a price hike, or how a forced index rebalance manipulates support levels, is how you survive. You have to look past the hype and focus entirely on the liquidity mechanics.
Which brings us to a final lingering thought for you to explore this weekend. We talked about Semiconductor's $7 billion pivot away from cloud data centers to focus on edge AI putting processing power directly into consumer hardware.
Right.
If the astronomical infrastructure costs of cloud-based AI are already breaking the pricing power of a giant like Apple, forcing an iPad up to $1,199, will forcing edge AI into every physical phone and tablet create an even more unsustainable hardware cost bubble for the consumer?
Or is building local AI the only way to bypass the massive toll booths of the centralized data centers?
We will leave you to mull that one over. Just remember, the next time you look at the implied open and the broader market seems perfectly calm and green, take a second to look for the lifeboats. You never know what's happening in the engine room.